Credit union leaders, here's what we're covering in today's episode. First up, if the Fed keeps cutting rates, how can your credit union turn that into a competitive advantage? Next up, are outdated compensation plans keeping you from landing top executive talent? And finally, operating costs are climbing. But is that just inflation or a sign of something more serious? Welcome to Grow Your Credit Union, the podcast where credit union leaders gather, learn, and grow. I am your host, Joshua Barkley, and I'm joined by my co-host, Becky Reed. Becky, what's up?
Howdy, y'all.
Howdy, Becky. Before we dive in today, I want to take a moment to mention our sponsor for this episode. They are a brand new sponsor for Grow Your Credit Union. It's SBS CyberSecurity, and they have some great solutions for your cybersecurity and GRC needs. It's very cool stuff, which you'll learn more about later in the show. Also, another quick note, we love hearing from our listeners. So if you have a topic that you'd like us to explore on the show, shoot it over to us at info@growyourcreditunion.com. Okay, Becky, if I'm not too good on today's show, I have an excuse. I haven't slept well in weeks because I got a second dog. Becky, I thought to myself, one dog, it's like 10% of the responsibility of a human, maybe 5, right? So I'm thinking you get a second dog, same thing, right? Maybe I'm at 15 to 20% the responsibility of an actual, no. They wrestle in the house. They don't sleep.
So I am an animal lover. I've always had at least one dog and one cat. And at one point in time, I did have 2 dogs, and I can tell you, I understand your pain. But I got a puppy 5 years ago, so in 2020, and I will never, ever, ever get a puppy again in my life because it was about the death of me. At my age, being an empty nester, I'm having to follow around this dog that put everything in her mouth. She swallowed things she wasn't supposed to. She chewed things she wasn't supposed to. We had to take her to the vet 3 times to have stuff taken out of her stomach. And I thought I was just going to die. And so I feel your pain. I've also heard that once you get the other dog, right, their dogs are pack animals. And once you get the other dog, then now that dog becomes their pack as opposed to you being their pack. So I think you just canceled yourself, Josh.
All right, Becky. Well, that helps a little bit, Becky. Thank you. Thank you for going over that with me here. You know, we are excited because we're welcoming back one of my favorite guests. He's the Executive Vice President and Chief Operating Officer at First Service Credit Union. I'm talking about Nolan Waltman. Nolan, great to have you back on the show.
Hey, thanks for having me. I had fun last time, and looking forward to doing this again.
According to Fed projections, more than half of committee members expect 2 additional rate cuts in 2025, potentially bringing rates down to 3.6% by year end. That's a full 30 basis points lower than their June forecast. So in other words, this could be the time for credit unions to reprice, refinance, and win back rate-sensitive members. Nolan, a lot of people are talking about the Fed cutting rates, and the way that they're talking about it is like the supermarket's giving away free groceries. Like my grandmother called me last week and she's like, hey, the Fed's lowering rates, as though I know what I'm supposed to do with that information, right? So my question to you is, if rates keep dropping, what is the biggest opportunity you see for credit unions?
Well, the ride down with rate cuts is typically the fun part for credit unions. It's the ride up that's rough. That's because liabilities such as CDs and money markets reprice much quicker than the assets. So the hard part is over, more or less. But now's the chance for credit unions to capitalize on lower rates by offering auto refinance promotions to capture new loans and memberships from consumers who've been stuck with higher rates over the past couple of years. However, the ride down is not always rainbows and unicorns. Anticipate an uptick in loan cannibalization by savvy consumers seeking to take advantage of lower rates being offered by other financial institutions. House sales have slowed down tremendously, and so you can expect to see more purchases, home equity loans, and even refinances coming. So working with your members, educating your members, and staying on top of their activities is going to be extremely important.
Becky, anything you want to add in terms of opportunities that you're seeing right now, or not seeing right now, but opportunities that come to mind in the event that the rates do lower as expected?
I think they'll continue to lower too, and I think they'll continue to lower as we get into 2026 as well. I think that it was really challenging for credit unions, all financial institutions actually, but particularly credit unions for the reasons Nolan mentions, right? The hard part is the ride up, and many credit unions didn't handle that in the best way. They took too long to increase their rates, and it's been hard on consumers, right? It's hard to afford a house or a car when the interest rates are higher. It makes it easier. The payments are less, right, when interest rates go down. I think that the challenge for financial institutions is that there are refi opportunities at every rung of the ladder. So as you continue to go down, you're refining at 25 basis point drop, then you're refining at 50 basis point drop, then and you continue to go down. And that's a lot of operational costs tied up in refinancing either loans that are already on your books if you choose to do that, or new loans coming in. I think that really is the nuance where financial institutions have to figure out a way to make their members happy, continue making new loans because loan demand will pick up as interest rates decrease. And people who've been sitting on the sidelines waiting to sell their house, waiting to buy a new house, waiting to move, get a new car, all of those things will certainly pick up. But managing that cannibalization too that Nolan talked about, that's really a challenge because volume, which will increase. The volume's going to increase.
Becky, real quick, the cannibalization thing, just to double down on that in layman's terms to just help me understand at a high level what we're really talking about with that. Could you break that down for me?
Absolutely. So what happens is a lot of times you want to bring in new loans at the lower rate. You don't want to refinance existing loans that are sitting on your books at a higher rate and rebook them at a lower rate. However, if you don't do that, you risk losing the loan altogether. And so there's a fine line where, you're having to basically reprice a 6% loan at 5% and you lose money on that deal, right? But you have to look at the long-term relationship that you have with the member. And it's possible you can maybe package that lower interest rate refi, which doesn't necessarily need to take a lot of operational time and cost to do that because you can just do an amendment to the loan. You don't have to rebook the whole loan necessarily. But then LTV comes into play. So, there's a lot of things you have to decide operationally, what you want to do, what you want to offer. But you can package that with maybe they'll bring another loan in that they don't already have with you, right? Maybe in exchange for repricing your auto loan that you have with us, bring us your spouse's auto loan or bring us your mortgage loan or something like that. So it does absolutely eat away at your existing portfolio and the higher yields you're already earning on that portfolio. But the opportunity cost there is you might lose the loan anyway if you don't do it.
Gotcha. Okay. Aside from the cannibalization then, Nolan, do you see another type of competitive pressure in terms of, does this mean more fintechs are going to come out of the woodwork? Does this mean there's going to be more competition for all this refinancing that maybe credit unions are not ready for?
Yes. The reality is fintechs are pushing technology to its fullest extent. And the one thing that really separates them from credit unions is they give their clients immediate gratification. And sometimes credit unions as a whole are kind of slower to adopt newer technology. And so fintechs have really placed themselves in a position where they can capitalize on this type of environment.
And then Becky, last thing on this particular segment, you mentioned the operational bottleneck. Because now if all these refis are coming into the credit union, there's all this operational back office stuff that needs to happen. Do you think that if there really is a refi boom, that in some cases credit unions won't even really benefit immensely from it because of the operational costs added?
100% yes. And I think that a lot of times we don't take that into consideration, right? Because refinances and new loan opportunities that maybe we haven't capitalized on before because demand has increased, your call center calls increase, your loan underwriting applications increase, your adjudication of each loan as you're taking a look at, whether or not we do want to give this person a lower rate. I just talked about LTV a minute ago, and LTV's been kind of crazy because cars have been, a truck is 6 figures now, which is absolutely insane. And we all know vehicles don't hold their value. And the housing market has kind of had some crazy ups and downs. And so you've got to have people taking a look at these things. You also have to repull credit in some cases. Are they still a good credit risk? And then you have to have somebody physically to change the rate or rebook the loan or send out paperwork or whatever the case may be. So there's a lot that goes into it with increased demand and increased refi activity, 100%.
In his Credit Union Times article, The New Rules of Credit Union Executive Compensation, John Pesh from TrueStage says, credit unions are getting caught in a trap. They spend all their executive benefit money on retiring CEOs, then can't afford competitive packages for their replacements. He sees boards committing their entire portion of benefit funding to the outgoing leader, leaving nothing for the next hire who has to compete against bank and fintech offers. Pesh's solution is working with benefits consultants to create funding plans. So aside from what Pesh recommends, let's just look at this topic holistically at a high level. He's talking about the compensation plans not being fundamentally structured in a way that helps credit unions compete to get the best executive talent. My question for you, Nolan, do you think John's right that credit unions are getting trapped between taking care of the past leaders and being able to afford future ones?
Well, I don't know if I 100% agree with this assessment. Now, there might be some credit unions that have found themselves in this situation, but I don't know if it's an issue that is plaguing the industry as a whole. The real issue that I've seen recently as it relates to departing leaders is the massive payouts that come through mergers and the CEO facilitating a merger. I mean, there was a local credit union here that found themselves in a bit of hot water when the CEO is receiving and the executives a payout 57% of the credit union's equity, right? I think people need to realize that this is a cooperative. This is the members' money. We're not for profit, but we do need to make money to keep the lights on, obviously, but we don't have the luxury of shareholders and investors like banks and fintechs do. But nonetheless, getting back to your original question, I think boards can plan accordingly for departing CEOs and still attract new talent. I mean, this can be done through succession planning, retention bonuses. Me personally, I tend to be a fan of the compensation at risk approach. I understand that you need a salary that is attractive enough to bring in new, fresh talent, new ways of thinking. But at the end of the day, the CEO's compensation should become effective when they do. I mean, to be blunt, right? So when you structure their compensation around things such as performance objectives, goals, company metrics, they tend to be a little bit more driven, and it kind of creates a win-win situation, not only for the credit union, the CEO, and its members.
Yeah, I mean, hey, what a novel idea, performance-based incentives. You know, John, I don't think kind of talks about that, and no offense, John, if you're listening right now. We'll get back to that because, Nolan, you said a few things that I really want to unpack, but I want to throw the mic over to Becky to get her take on this particular topic.
Well, I agree with Nolan about performance, and in credit union land, we don't do a great job, I think, of that. Also, there's a little bit of a trap. Whenever I was a CEO, I told my board that every single metric that they were going to grade me by, I could manipulate for my benefit if I wanted to. So, if they tell me the loan yield needs to be X, well, then I just make sure that our interest rates are high enough to meet that. If they tell me that we need to, have a certain number of loans that have to book every single month, well, I can do that by making sure our underwriting standards maybe are not at the highest level. So I preferred to have my performance-based compensation predicated on other things besides that. It's a little bit of a conundrum when it comes to the CEO, but my take on this would be, and I agree about the merger thing, I think that a lot of credit union boards don't make sure that there's a retirement plan in place prior to the CEO retiring. Therefore, creating a situation where in order to get a retirement plan, the CEO is encouraged to find merger partners in order to get something that should have been established for them a decade ago. I think that that's where I take issue with this particular article, because there shouldn't be retirement payouts when the CEO says he's retired or she is retiring. I mean, that seems silly. You set those things up beforehand, and maybe there are performance metrics that are attached to it. Maybe there are longevity metrics that are attached to it, or whatever it might be. But when I announce my retirement, that's not the time to decide how much to pay me.
Yeah, that's a strong point, Becky. Nolan, coming back over to you, you mentioned that we are a nonprofit. And I think what this article really made me think of at the highest level is just simply, can credit unions compete for top tier executive talent from a compensation standpoint? So do you think, Nolan, it's kind of a product of, we don't want executives in the credit union space unless they're aligned with the mission anyways? And if they're not aligned with the mission, it doesn't matter how much I'm going to pay you. Is that kind of the gist of what I'm sussing out from you, or not quite?
Yeah, it's unfortunate that credit unions are not really all that sexy compared to fintechs. Now, you might have a large credit union that's 10 plus billion that might be able to attract a really strong CEO, but a lot of compensation is really driven by the size of the credit union and its assets to know what they can afford. It's a tough battle out there. And so finding somebody who believes in the movement and feels that there is a purpose in the credit union movement, that's really where you're going to be looking, and then just trying to capitalize on the best in the market.
Becky, any last takes on this one before we move on?
I think that it's important to double down on the mission 100%. I think that compensation packages in the banking world, to Nolan's point, they can get shares of stock potentially in a privately held bank. Even in a publicly held bank, they could have stock options as part of their compensation package, which could lead to them caring about the performance of the organization, right? Because that affects the value of the stock. We just don't have that in the credit union space. And it is absolutely asset focused, which a little bit relates to the complexity of the organization. A $10 billion credit union is absolutely more complex than a $500 million credit union. But the compensation packages for a $10 billion CEO and a $500 million CEO is vastly different, I'm going to tell you. And from a $500 million credit union to a $100 million credit union is vastly different. And so some of it, and yes, it has to do with what the credit union can afford, but that affordability sometimes does relate to quality. And it's a challenge for our space. I'm not going to lie, it is.
Hey, I want to take a minute to talk to you about our wonderful sponsor, SBS CyberSecurity. I have spoken to over 100 credit union leaders in the last 3 years, and the thing that comes up time and time again, it's kind of like the most common priority that I hear from them, it's cybersecurity. Credit unions know what it means to roll up their sleeves and get the work done, and so does SBS CyberSecurity. That's why they built Track, the all-in-one governance, risk, and compliance platform made for credit unions that prioritize meaningful action over just checking the box. Track helps you organize, track, and manage everything from risk assessments to vendor reviews, all in one simple dashboard. No spreadsheets, no chaos, just clear insight and control. And now with the NCUA requiring a 72-hour cyber incident report, and more than 1,000 incidents were logged last year alone. So credit unions, you can't really afford to rely on manual processes. Cybersecurity and vendor risk are at the tippy top of the 2025 NCUA exam priorities. And Track keeps you exam ready every day. If you want to learn more about the Track product, actually, we have an incredible video on our website showcasing what they do, how it can help your credit union. So if you want to watch that video, check the show notes for the link and give it a watch. At SBS, they know what it means to get the job done and grow along the way. They started small. How small? They started in Madison, South Dakota. They partner with credit unions nationwide, and they even partner with 23 state associations. Learn more about Track at sbscyber.com. That's sbscyber.com. SBS CyberSecurity, built for credit unions like yours. According to Callahan and Associates' latest financial performance series analysis, U.S. credit unions are facing a concerning trend. Operating expenses have jumped nearly 7% annually over the past 5 years and have risen as a percentage of average assets for 13 consecutive quarters. Now, the culprits are familiar ones. There's nothing mind-blowing here, right? Inflation driving up employee compensation, office operation costs, fees for professional services, technology upgrades, strategic consulting, all of that stuff, the usual suspects. I guess my question for you, Nolan, is, are the rising costs in operating expenses merely a result of the cost of doing business in an inflationary economy? Or is this something that you think credit unions need to address?
Well, it's twofold. External factors such as inflation will always be present no matter what, and it will always be outside the credit union's hands. It's how the credit unions deal with it that separates the high-performing credit unions from the low-performing ones. In fact, I think this is what's actually contributing to the consolidation of credit unions. Every year, I see charts where the number of credit unions is going down. We're just becoming smaller and smaller. And it really shows that economies of scale is extremely important, because even outside of inflation, we have other factors that are hurting the credit union, whether it be CFPB or the second round of the Durbin Amendment. I mean, there's a lot of things that we're trying to stay ahead of. The amount of money it takes for a larger credit union to produce a widget for its members compared to a smaller one is very considerable. And so that's why everyone is rushing to achieve economies of scale. What credit unions can do, though, is embrace the future. AI and automation is here to stay. Talking with a lot of my peers and going through CUNA management school, it's interesting to see how many credit unions are still somewhat scared of AI or haven't even chatted with ChatGPT at all. It's going to be the credit unions that fully lean in and embrace this technology and not be scared of it are going to be the ones that come out on top. I mean, here internally, we're currently leveraging 3 different types of AI for underwriting. On the consumer side, then we're using some underwriting tools for the membership, and we're rolling out large language models in the contact center for a virtual rep. So that's going to be a big leap forward for us. I mean, even being at 1.4 billion, the ability to have a 24-hour, 7-day-a-week contact center is going to be big. And a lot of credit unions don't really have that in their back pocket. And so embracing this technology and positioning yourself to do things that you couldn't do before is really going to kind of put you in a spot to succeed.
Kind of double down on what you're saying here, Nolan, about AI. I'm looking at the charts of sort of the breakout of expenses 52%, according to this Callahan article, 52% of the expenses, employee compensation. We're thinking about AI. What does AI do? Typically makes your employee more productive. And then number two, in terms of expenses, around 18% office operations, exactly what you're talking about here. A lot of the things that AI can be doing in lending and just workflows, automation, moving that back office operations in a much smoother, faster capacity, that is all functions of AI. Becky, we're talking about operating costs, how they've been going up steadily. Let's just go back to the fundamental question that I asked Nolan, and then we can push on a few other things. But is this a concerning trend, the increase in operational expenses, or is this just the natural course of nature moving forward?
Okay, Josh, let's think about your life as a human. When have costs ever gone down?
Not since I've been alive.
They always go up, right? So that statement about operating costs in a credit union, okay, they've gone up in banks, they've gone up in retail, they've gone up in every other business that you can imagine, and consumers certainly feel that in their pocketbook as well. And so I don't think it's necessarily surprising that costs are increasing. I think that, to Nolan's point, however, there are some technological tools that are available now to help streamline expenses and automate things that perhaps were unautomatable before. Look, AI is a really, really great tool to use for large amounts of data. So for data analytics, which credit unions traditionally have not been great at as an industry, for trend analysis, for fraud reduction. So I think that there's opportunities for us to use tools to at least keep our expenses from going up, or give us the ability to reallocate resources to higher value things. The fact that operational costs are going up, I don't think is a novel thing. In 10 years, you're going to see the same thing. In a year, you're going to see the same thing. It goes up, 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 up. It never goes down. Nothing ever goes down. So we just have to look at our credit unions and make sure we're operating in the most efficient way. And the tools that we have available now, frankly, are kind of unprecedented. And even 2 or 3 years ago, these tools weren't available. So credit unions out there, and of course, this is my soapbox always, please, please, please do not stick your head in the sand and say, we're not using those tools because they're too risky, whether it be distributed ledger technology, whether it be AI. Look, everything has a risk, but if you have a good risk mitigation process at your credit union, you can understand what those risks are and move forward in a way that you're most comfortable with, depending on wherever your risk level is. But please take advantage of these things.
Well said, Becky. My concern is, Nolan, you're using AI in inventive ways. I talk to a lot of credit union leaders that haven't even begun to use it past level one process documentation. We use it to surface internal documents, maybe, right? So everyone's talking about the hopes of efficiency gains with AI, but I'm not seeing it play out, not at all, not even close. We're not even there, not even a little bit, right? So I guess I would say, kind of closing out this segment, I'm with both of you. If the costs keep going up and credit unions can't find a way to curb those operationally with AI or some other technology, it is going to be a big problem for the industry. So to Becky's point, you really need to get your head out of the sand, because you're going to need these operational efficiencies to survive. Am I right? Am I calling that right, guys?
Yeah. I mean, you don't have to dive all the way in to get started. I mean, a real life example that we have right now isn't even really AI. It's more on the automation piece. I mean, card disputes are a very intensive process, and Reg E has a lot of requirements. And so why would we not want to automate things where we're auto giving provisional credit or reversing it, or ensuring proper documentation is going out to members? I mean, your team can be so stuck in that loop that they can't even focus on what moves the needle and saves the credit union money, which is the investigation piece of a card dispute. So if you can remove all those mundane manual tasks so they can pick up the phone and call the merchants and try to determine whether this fraud is valid, that's what's going to save the members money. That's what's going to save the credit union money, instead of just taking losses because you don't have time to do proper investigations and you're butting up a Reg E requirement to close out an investigation at a certain time. So you don't have to open up with large language model. Just start with some basic automation and focus on that, and then go from there.
All right. That brings us to the end of our show. Nolan, do you have any final thoughts for our listeners, my man?
I just want to keep encouraging all the credit union leaders to take chances. Instead of being a follower of what fintechs are doing and banks, let's lead the charge and try new things, and fortune favors the bold.
If anybody's listening and they want to get a hold of you, what is the best way to do that, Nolan?
By email, Waltman, NWALTMAN @FSCU.com.
Becky, final thoughts.
This was a great episode because these are real things that people are working with every single day. And so I'm hopeful that people get some takeaways from some of the things that we have talked about today. And I completely agree that fortune favors the brave or the bold. And I do encourage credit unions all the time to continue to be bold, because at the end of the day, we are financial cooperatives, right? And our whole focus is to be there to provide the services that our members need to help them live their best financial lives. And so that's what we do. And sometimes that means moving first.
Becky, if the listener wants to get a hold of you, how should they do that?
LinkedIn all day.
I knew the answer, but I had to ask. All right, Nolan, thanks for coming on. Becky, thanks as always for being a great co-host, and a huge thanks to SBS CyberSecurity for sponsoring this episode. Remember, SBS CyberSecurity is there to make you exam ready with Track. We really appreciate them for sponsoring us and allowing us to continue doing what we do for you. And as always, a great big thanks to you, our listeners, for continuing to support and listen to another episode of Grow Your Credit Union. We will see you next time. Take care. Bye-bye.